Hi, everyone, and welcome back to the Surviving Retirement Podcast. I'm Danny, and with me we have Peter.
Thanks, Danny. I'm Peter Guidote, Chartered Accountant, Certified Financial Planner, and Senior Portfolio Manager at CG Wealth Management.
Today we're talking about RRSPs, Registered Retirement Savings Plans. They're one of the most important tools for retirement planning in Canada. But let's be honest, a lot of people still have questions. So in this episode, we're going to walk through everything you need to know to use them with confidence. Peter, you are the expert, so why don't you take it away?
Of course, thank you. An RRSP is a government-registered account that helps Canadians save for retirement in a tax-efficient way. It offers a number of benefits, like reducing your taxable income, allowing your investments to grow tax-free, and giving you flexible options when it comes time to withdraw. But while the account itself is simple in concept, the rules, limits, and strategies can get complex. So understanding how it all works is key. In this episode, we'll start with the basics, what an RRSP is and why it's useful. Then we'll move into contribution rules and limits, how the tax advantages work, what happens when you withdraw, and finally, strategies to help you get the most out of your RRSP.
Perfect. Whether you're just getting started or looking to fine-tune your retirement strategy, this episode's for you.
Let's get started. All right, let's start with the basics. What exactly is an RRSP, and why is it such an important part of retirement planning in Canada? The RRSP was introduced in 1957 by the federal government as a way to encourage Canadians to save for their own retirement. And the key benefit, it's the tax deferral. When you contribute to an RRSP, those contributions reduce your taxable income for the year. And the investments inside the account, whether it's stocks, bonds, mutual funds, grow tax-free until you take the money out.
Okay, so it's not just a savings account with a fancy name. How would you say it compares to like a regular savings account at a bank?
Great question. So, a regular savings account earns interest, but that interest is taxed every year. With an RRSP, none of the growth is taxed until you withdraw the money. And that's what makes it powerful, especially for long-term savings. You're not just saving, you're letting your money grow without paying tax on it along the way.
Right, and I've heard people say tax deferral like it's a magic phrase, but why is that actually helpful? I mean, doesn't the tax eventually catch up with you?
It does, but timing matters. The idea is that you're deferring tax to a time when your income is likely to be lower, usually in retirement. So when you take money out later, ideally, you're paying tax at a lower rate than when you earned it. And in the meantime, your investments are growing faster because they're not being taxed year after year. That compounding effect can really add up over time.
So it's like you're giving your money more room to grow before the government takes a cut?
Exactly. It's not tax-free. It's tax-deferred. But that deferral creates an advantage, especially if you plan well around how and when you withdraw the funds.
All right, so we've covered what an RRSP is and why it matters. Now let's talk about how much you can actually put into one. Because this is where people often get tripped up. There are rules, limits, and even penalties if you're not careful. Peter, can you walk us through how RRSP contributions work?
Absolutely. So RRSP contribution room is based on your earned income from the previous year. Each year, you can contribute up to 18% of that income, up to a set maximum dollar amount, which is adjusted annually by the government. For example, for 2025, the maximum contribution limit is $32,490. And if you don't use all your contribution room in a given year, it doesn't disappear. You can carry it forward and use it in the future.
Okay, so that 18% is based on earned income. What exactly does that include?
Earned income generally includes things like salary, wages, commissions, and self-employment income. It does not include things like investment income, rental income, or pension payments. So if you're retired or not working, you won't be building new RRSP contribution room.
Got it. And if someone's not sure how much contribution room they have, how do they find out?
The easiest way is to check your most recent notice of assessment from the CRA. Your available RRSP contribution room is listed right there. You can also find it through your CRA My Account online, which is a great tool for keeping track.
And what happens if someone goes over their limit, by mistake or otherwise?
If you overcontribute by more than $2,000, the CRA charges a penalty tax of 1% per month on the excess amount. That's why it's really important to keep track, especially if you have automatic contributions set up or are contributing to multiple RRSPs through different institutions.
Yeah, that could add up quickly if you're not paying attention.
It can. There is a $2,000 buffer, which can be helpful, but it's not meant to be used as extra room. It's more of a cushion for honest mistakes.
All right, so we've covered how to grow your RRSP, but what happens when it's time to start taking money out?
When you withdraw funds from an RRSP, that amount is treated as taxable income in the year it's withdrawn. That means if you take out a significant amount in a single year, it could push you into a higher tax bracket and increase your overall tax bill. So it's important to think carefully about the timing and size of your withdrawals, especially in retirement.
And there's also a deadline, right? You can't leave money in an RRSP forever.
That's correct. By the end of the year you turn 71, you must convert your RRSP into a registered retirement income fund, or RRIF, or purchase an annuity. This marks the transition from saving to drawing income. With a RRIF, you're required to begin withdrawing a minimum amount each year starting at age 72, and those withdrawals are also fully taxable.
Let's talk about early withdrawals. What if someone needs to access their RRSP before retirement?
If you make an early withdrawal, the amount is still taxable, and your financial institution will apply a withholding tax at the time of withdrawal. So for example, if you withdraw $10,000, a portion anywhere from 10% to 30%, depending on the amount, is withheld and sent to the CRA as a prepayment. But that might not cover your total tax owing depending on your income when you file your return.
So early withdrawals aren't just taxed. They could result in a higher tax bill if you're not careful.
Exactly.
Now, there are a couple of exceptions that allow for early access without immediate tax consequences, right? Notably, the Home Buyers Plan and the Lifelong Learning Plan. Can you tell us a little bit more on those?
Certainly. The Home Buyers Plan allows eligible first-time buyers to withdraw up to $60,000 from their RRSP to purchase a home, and the Lifelong Learning Plan lets you use your RRSP to fund post-secondary education or training. But both programs require you to repay the funds over a set period. If you don't, the unpaid portion is treated as taxable income in that year.
Got it. Now back to RRIFs. How do the required withdrawals work?
Once your RRSP is converted to a RRIF, you must begin withdrawing a minimum amount each year, starting the year you turn 72. That percentage increases as you age, and again, every dollar withdrawn is taxable. So this becomes a key part of your retirement income and your tax planning.
So no matter how or when you withdraw from an RRSP, taxes follow.
Exactly. RRSPs are powerful, but their real value comes from using them thoughtfully, both while contributing and when drawing down the funds in retirement.
All right. We've covered what RRSPs are, how they work, and what happens when you withdraw. Now let's talk about strategy. Because if you use an RRSP the right way, it can do a lot more than just help you save.
That's right. At its core, an RRSP is a tax deferral tool. So one of the most effective strategies is to contribute during your high-income years, when you're in a higher tax bracket, and then withdraw during lower-income years, like in retirement. That gap between the two tax rates is what creates the value.
So you're basically trying to save tax while you're working, and then pay less tax when you're living off your savings later.
Exactly. Another key strategy is income splitting, especially in retirement. If you have a spouse or common law partner, and one of you earns significantly more than the other, you can shift some RRSP or RRIF income to the lower income spouse. This helps reduce your household's total tax bill.
That sounds like something people should plan for well in advance, not just once they retire.
Absolutely. And another area where strategy really matters is around old age security, or OAS. If your income in retirement gets too high, you could face an OAS clawback where the government starts reducing your benefit. We touched on that in our last episode. But by using your RRSP withdrawals to help manage your taxable income, you may be able to stay below that threshold and avoid losing those benefits.
Okay, so it's not just about saving money in an RRSP. It's about how and when you take it out that really makes the difference.
Yes, and that brings us to one of the most common mistakes, treating the RRSP like a simple savings account. Some people overcontribute when they're in low-income years and don't get the tax advantage they could have had later. Others withdraw too early or too much in retirement, which can create unnecessary taxes and affect other benefits like OAS or GIS.
Are there strategies to coordinate RRSPs with other retirement income, like CPP or QPP, OAS, or even a pension?
There are. A good retirement income plan will map out when to take each source: RRSPs, CPP or QPP, OAS, maybe even a TFSA. The goal is to smooth out your income across retirement, minimize taxes, and make sure you're not triggering avoidable clawbacks or penalties. It's not always straightforward, which is why personalized planning makes a big difference.
So it's really about thinking ahead, both with how you contribute and how you withdraw.
Exactly. RRSPs are flexible, but that flexibility means you've got to use them wisely to get the full benefit.
That was a lot of great insight. It really shows how much of a difference smart RRSP planning can make. Not just now, but all the way through retirement.
RRSPs offer real value, but only if you understand how to use them properly. Things like when to contribute, how to avoid penalties, and how you time your withdrawals, they all play a big role in your overall retirement picture.
And that's why personalized advice is so important, because the right strategy depends on your income, your goals, and your other sources of retirement income.
Exactly. If you're not sure if your RRSP strategy is working as hard as it could be, consider booking a free 30-minute consultation with a member of our team. You'll find the link in the description, or just scan the QR code on your screen. And if you'd like to keep up with industry trends and more retirement tips, consider subscribing to our newsletter. You'll receive a complimentary estate record keeper to keep track of your assets and make it easier for you and your family.
And if you found this helpful, make sure to like and subscribe so you never miss an episode. We've got plenty more retirement planning tips coming your way.
Next time, we'll be talking about tax-free savings accounts, how they work, when to use them, and how they compare to RRSPs in a real retirement plan. Until then, be kind to yourself and to others, and we'll see you in the next episode.
Take care, everybody.